Hey, look, it's great to be here this evening in Mackay. And I'm going to say up front, and you'll think, oh, you can't get the politician out of him, he's just pissing in our pocket. But I do love Mackay. And the reason I say that is of anywhere around Australia, we've got more property here than anywhere else. So we've actually got 5 commercial property assets here, 3 industrial properties in Paget, a medical centre on Nebo Road, 142 Nebo Road, which we bought off Paul Maguire, who's already had a cameo role this evening in the video. And also we just recently bought a large format retail asset up at Mount Pleasant. And we have really been happy, and so have our investors, to invest in your city. So it's something that I really, really mean. So I'm not actually involved in investor relations. My bit is to go and buy stuff with a young fellow by the name of Nick Sinclair. The people who really should be here this evening are Peter Eccleston and Colby Phyllis. Peter's one of the 2 other partners in Arcana. The other person is Christina Condon. So really, we're a partnership of 3 families. We're a small fund, we're a boutique operation, but we've got around Australia now about $240 million worth of commercial property. To do that, we have our own Australian financial services licence that permits us to offer what ASIC deemed to be a financial product to wholesale investors. So wholesale investors are those with sufficient wealth and financial acumen to make decisions, according to the government, as opposed to retail investors who are given greater protections under the corporations law. So what I'm going to talk about this evening is general product advice. In fact, I won't even be really specifically talking about any particular product, but I just have to say that. And so what I'm talking about is for wholesale investors as well. That's my disclaimer. We're also a licensed Queensland real estate agent. We've got a corporate licence, and we've got a couple of people who work in the team, including my wife, who've got real estate agent licences as well. Thanks, Cecilia. So what do we do? And it's not going to be a big ad for Arcana. I will talk about Arcana, but I'm really going to be offering sort of advice and commentary that will help you if you want to go and invest yourself or with anyone else. And it really dovetails well in a lot of the stuff that Paul has said, because he's covered detail that I will then be able to refer to as well. So what we do is we go out and find assets, we acquire them, we put them into a unit trust. In fact, more specifically, it's held by a custodian, being Perpetual Corporate Trust in Sydney, but we create that structure and framework so that people can have a slice of the action. And people buy units in a unit trust that we have established. And so our pitch to investors is we will buy that asset there, put it in a trust, and then if you want to invest in that one, well, you take a share. And then we have, if you like, a production line of things coming forward, deals we're doing, and people can say, yes, 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 no, I don't like fuel stations, I'm not investing in that one. And people can devise their own portfolio. But if they'd invested the same amount of money in everything we've got, including one asset in Gladstone, which I always talk about because it's not performing and paying a return at the moment, they'd be receiving an average net income distribution of 7.63% on their investment. And of course, we invest in everything ourselves. So as the 3 partners of Arcana, we think it's critically important that we always invest alongside our investors as well. And it's a bit of a club. We know our investors. We've got about 200 regular investors. We're on very good terms with all of them, and we deliver a very personalised service to them. Thanks, Cecilia. So why commercial property? Well, like Mark said at the beginning, I love this stuff, and so do my business partners. We just love it. That's what we get up every day to get into. So firstly, the pros. Well, there's better income and capital returns than with residential property. But hearing what's going on in Mackay, that's pretty tasty, I've got to say. That's not quite to the same level of normal commercial property returns, but it's getting there. But of course, there are higher risks. And I can tell you now, if you don't follow the sort of guidance that Paul was talking about earlier on, you can blow up money, and we've seen people make some very big mistakes. We've helped people out who have been associated with our clients on occasions, try and rescue situations, but you have to do your homework. You've got to do this due diligence thing. I love it. I've never been a person for shares. I must be the only person in Australia to buy bank shares and lose money. I've got to tell you, that's so. I'm really about being master of my own destiny, that third point, but I love the security of bricks and mortar. I have a self-managed super fund, I have a company, I also have a family trust. We invest in all three. We're heavy on commercial property. I like the transparency of the business case, and particularly that's why we do what we do. There's the asset. There's an office building, say in Perth. We can look at it, we can study it, we can look at the costs, we can look at the income from the rent. We know what we're getting. Whereas if it's with a whole lot of other assets in a real estate investment trust run by the big guys, we really don't know what we're getting. That's what our investors like about it too. Finally, and it pains me to say this, and I'm being political, but there is madness afoot in the land. We are seeing people in various political parties today propose measures in the residential property market to constrain landlords' rights in terms of what they can do with their property, and in terms of how they set rents and how often they can set rents. And these are the discredited, fraudulent policies of 50, 60, 70, 80 years ago. Rent control doesn't work, ladies and gentlemen, never has, never will. The idea that negative gearing should be got rid of, Paul Keating and Bob Hawke tried that back in the late 80s, and that didn't work out too well, and they brought it back. And here we have a new generation of politicians suggesting all these mad schemes that won't work. The point here, though, is when you get to commercial property, you have far less of those sorts of things. You do a bit in the retail space with the retail tenant legislation here in Queensland, but you're not exposed to the same sort of, unilateral and capricious changes, knee-jerk changes that many of our political figures would seek to impose today. So that's the one thing that scares me about residential property. The cons. Look, I'm sure there's some very wealthy people in this room tonight. There's a lot of wealth in Mackay. But, if you're buying stuff at the low end, even at the low end, like a strip shopping centre shop or two, you are up for some serious money. And, up to about $7 million, by the way, there's intense competition from private individuals. So for things like your Hungry Jacks or your Red Rooster or your Subway, Mark, there's a lot of competition for standalone assets, and those yields tend to be bid right down. If you go to Sydney or Melbourne, you're looking at net yields on those sort of assets going down to about 4.5%. And we won't play in that space. And that's why we try and operate sort of north of $7 million these days. So the assets in the lower price brackets are now overpriced. There is a lot more complexity in the acquisition process and requirement for due diligence. I'm going to hammer this. It's really important. If you'd said to me back when I started this business with my partners, if you'd said, this is pretty complicated, this game, I'd have gone, oh, come on, it's property, how hard is that? Well, it's deceptively simple. The point is you have to have a process, you have to go through the thing in the right steps. There are so many different laws that can trip you up. There's different legislation, say the Stamps Acts in different states. It's quite different how they treat you for stamp duty and indeed land tax, and you really need good legal advice and you need other experts to help you along the way. Finally, unless you're dealing with ASX-listed tenants, the actual tenant risk can be more significant. Now, there's a lot of hardship out there now in retail land for businesses that are in delivery of discretionary services or products to people in the community, and we're seeing it in Brisbane where people are these are tenants, are clearly under pressure and are having difficulty paying their rent. And it's quite sad. We've got to be tough. We've got to show them tough love. During COVID, we worked hard to keep people afloat, and that was really that was actually really satisfying to help a number of small businesses there. But now it's really to the point where there is no government support and people are really being pushed to the wall. But having said that, you can have a bad experience with an ASX tenant. I reflected on an asset in Gladstone that's generating $0 as we speak today for the investors, and that's because the ASX tenant that was originally in the building, a top 200 company, went bust, and that was after being in operation for 100 years. So it can happen, and you need to always think about losing your tenant. Thank you. So this is a real eye test, I'm sorry. I'll probably talk to it a bit, but this is our process which we follow, and it's a cookie cutter process. We do it again and again and again. We're constantly looking at the market. So we've got people all around the country, particularly Mark Kelly and Mackay, ringing me all the time saying, you know, how about you look at this, how about you look at that? So there's a fire hose we sit at, and we're constantly assessing and shortlisting opportunities. Every now and then we find something we like, and we do a really detailed evaluation. And so what do we look at? Well, we're looking at tenant risk, the inherent risk of the property, the market risk, the interest rate risk, adverse effects, and sovereign risk. Peter, who I mentioned before, and I bagged, who wasn't here, hopefully he'll watch the video and know that I bagged him. He thinks about everything. You know, it could be, there'll be a tidal wave or a volcanic eruption in that, or earthquake. Seriously, we've got a dynamic in our business which is quite healthy. I tend to be the optimist. Christina's about the middle, and Peter's thinking about all the bad things that could go wrong. And you need that. So if you're sitting there around the family table deciding what you buy, don't all just be on the sort of the enthusiasm sort of bandwagon. It'd be really good to have someone to really think about the bad things that could happen and state that up front and have the argument, have the debate. Anyway, eventually we might find something and we secure the opportunity. Now, Paul mentioned about contracts and the entity. What we do in Queensland is we have a thing called a put-call option deed, which allows us to say, well, at the moment Arcana's buying it, so Arcana's on the actual contract, but then we have the ability, the right, to then nominate the entity that's going to own it. So if we're going to buy, you know, the property at 10 Bridge Street, Mackay, we will set up an entity called the 10 Bridge Street Mackay Unit Trust, and we'll do that after the event, after we've got it under contract. And so we're allowed to do that, and it means if we follow the right steps that we don't get hit with stamp duty twice. So then we do this due diligence. We handle that in two ways. One is that we do it ourselves. We've got expertise within the team. I'm an engineer, Peter's an engineer. We've got some young guys who are very well trained up to look at things. We also employ a firm called Colin Biggers and Paisley Lawyers, who are sort of like a second tier but national law firm, and they do a full legal due diligence. They order all the searches that Paul alluded to. They go into all the leases and do lease reviews. Mind you, we do all that ourselves. We're doing that probably back around here to make sure there's no sort of bombs embedded. We're trying to work out if the thing stacks up. When you're looking at a property, you've got to look at particularly stuff like obviously the building fabric. You know, is it well built? Is all the documentation right? Certificates of classification, or as they're called nowadays, certificates of occupancy. Outstanding maintenance. In Mackay, with your warm, salty sea breezes, stuff rusts really, really well, and that's something we always have a really good look at. You know, roofs. We always inspect air conditioning plant. That's a big one. If it's retail, if it's got lifts or escalators and things like that, those are the things that are really going to cost you money that you need to then have a plan for. And it might be that you think you can borrow more money from the bank, or it might be that you put money aside. What we do is we'll do the once-over ourselves on the building, and we'll say, okay, we're buying that office in Canberra. We need to allocate $1 million for capital upgrades and $500,000 for lease incentives. So we write that into our business case. We've established the entity. We then borrow from the banks non-recourse. So if it's done properly, what does this mean? It means that the only recourse from the financier is against the asset and the bank accounts of the trust. So there's no personal liability if you do this right. And the banks will lend non-recourse to these sorts of operations like ours if the right sort of right sort of framework is there. So you've got to have a financial services licence. You've got to keep the limit. You've got to limit any one investor having more than about 20%. Maybe we try and keep it to about 15. So there's no dominant interests. So you've got to tick a number of boxes. There's also some of them make us sign forms about self-managed super funds and whether they're in compliance, etc., being able to invest. But we get non-recourse debt, and that's a tender process. So we borrow against the bank bill swap rate, BBSY, and the banks will bid on a margin, providing debt against a margin against the BBSY. And then there's documentation. So for us, it's about an information memorandum which sets out what people are buying into, what the deal is. There's a trust deed, of course. There's a unit holders agreement which governs the relationships between people in this little investment and how it works. What are the rules of the game? How do we sort of relate to one another? How do we sell the property, etc.? And then there's an asset management agreement which sets out basically what Arcana must do to get its fees. So we've then settled the property. What we do then is we pay monthly distributions, money going to the bank account. We try and do ongoing management and value add. So we might put solar panels on the building and crack a deal with the tenant and get some extra income for the trust. We might have to do some leasing work. So what we did a few years ago here in Mackay is we bought 56 to 60 Len Shield Street at Paget, and then Mark helped us get a great tenant, being a Steel Arc, and they've done really, really well, and it's been great for us, and that has created value for our investors. And then ultimately we will sell it. And this is the sad thing, because I'd like to, if I could, retain everything, but the deal is we have to have an exit strategy for people. So it's usually between 5 to 7 years that we'll own something, and then we have to actually sell it. That's the rules of the game.
Is that up tomorrow?
Up tomorrow, yeah. Sell it tomorrow? No, yeah, well, you'll have your moment, mate. Yeah. Thanks, Cecilia. So, how's the market going? So my comments now are not based on Mackay, they're based on a national perspective. Sorry, by the way, I should have said, where have we got stuff other than Mackay? Well, Tully, just at Silky Oak to be more accurate, we've got a big industrial cum logistics facility for Mackay's bananas and Visi. So that's our northernmost asset. Flooded 2 weeks ago. Did I mention flood risk? Well, you know all about cyclones as well here, but so that's another thing, of course, we're always looking at in Queensland. But Tully, then Townsville, Mackay, Rocky, Gladstone, Brown Brisbane, etc., right around the coast. So that's the way I'm talking about this. So retail, local convenience, at the moment, expensive. And when I say expensive, there's a little picture there of a shopping centre at Southern Redland Bay, and that's probably got a yield on a sale at the moment of about 6.25%, maybe 6.5%. There's a fuel station there, a 7-Eleven. They've been very expensive, although about May last year the market softened and buying is good there at the moment. It's interesting in fuel. I think every now and then there's a barrage of stories about electric vehicles and everyone's going, electric vehicles, and no one will want liquid fuel. And I think people then don't want to buy. They think that's a stranded asset. And then there's stories, as we saw coming out of North America about 6 weeks ago, with the terrible winter weather where it was all about EVs being stuck in the snow and not being able to recharge. And then I think people think maybe these things aren't so good. And so then I think sentiment returns. But it has been expensive. Retail bulky goods, well, a bit of an opportunity there. So these are sort of your Anacondas or your Pet Barns, BCFs, those sorts of things. They have been expensive, but we bought very well here in Mackay at Mount Pleasant last year. Mind you, the syndicate had owned it out of Melbourne. They'd had it for many, many years. And I think they just wanted ultimately to wind up that syndicate. So anyway, we might have been the right place at the right time. Medical and allied health has been quite expensive, but I think again the heat's coming out of that at the moment, but still fairly expensive. Industrial facilities and warehouses generally around Australia, red hot. There was a story in, I think, the Australian Financial Review today or across the weekend, and you know, industrial in our capital cities is now more expensive than office buildings. In fact, the value of the industrial sector is now worth more than the office sector, which is extraordinary, but that's the case. Finally, office properties, CBD and suburban, and I'm now referring particularly to our capital cities. That's an opportunity at the moment. The reason it's an opportunity is of all the sectors in commercial real estate, this is where the capital rates have softened. So whereas a few years ago, an office building in suburban Brisbane might have gone for 6.5%, by the middle of last year, they were more likely to be at 7.5 towards 8. So they'd softened by 120 plus basis points, 1.2%. Now, we've bought a few. We bought one in Perth, just outside the CBD. We bought one at 8 Mile Plains in Brisbane. We bought another one in Canberra, in Phillip and in the Woden Valley, and we did very well in terms of buying. The trouble is, though, that people go, oh, I read the AFR and I heard it's really bad in office. I don't think I'll invest in an office. So that's a buying opportunity, but you know, it's harder to raise the money and convince investors. But those are my sort of comments of the on the market around Australia at the moment, without reference particularly to Mackay. Thanks, Cecilia. So what about the economy? Well, Mark alluded to this earlier on. Interest rates, it's been extraordinary. You know, up by 425 basis points since the start of 2022. And as I just said, the market hasn't moved too much except for office. It is starting to move now in some sectors. But thankfully, interest rates will be down 50 to 100 by the end of 2025, they're saying. In fact, there's some even more bullish sort of predictions. And that's, I suppose, encouraging. We hope that's the case. Personally, I believe that the RBA went one time too many with the last one. And as I was alluding to it before, there's a lot of real pain out there, particularly in the capital cities. People are really under pressure. You know, sort of middle-class families, mums and dads trying to pay the mortgage and then look after their families. And then you see that flow-on effect to small retail tenants. Arrears. That's something, going back to your due diligence stuff, that's a big one for you to go on. If you're looking at a commercial property, but particularly retail, you must see the arrears. You know, you must ask the vendor, you know, they have to disclose those arrears to you. And you then look at the level of arrears compared to the overall, you know, monthly or yearly income, and make a judgment about whether you think, you know, they're on top of it, because that's where the warning signs come through that people are struggling, and you're going to have a tenant that's suddenly that you've had to lock out, which would be very you know, that's one of the things. If you own a retail property and they can't pay, well, you know, there's a process, but you might be in the position of having to lock someone out. It's not very nice, you know, I can tell you that now. Rent reviews, fixed or CPI. Well, I was, not to be too much of a smart aleck about it, I was always a big one for CPI reviews going back well before COVID. So I guess you've got to be right every now and then. It's like the clock that is right twice, the stop clock that's right twice a day. So I was right on that one at the moment. But I do like CPI reviews. In fact, my best type of review that I'd like to see in a lease is CPI plus 0.5% or plus 1%. Woolies and Coles. Look, we've looked at them time and time again. They're really bad leases. It's like they're not. They're for Woolies and Coles. They're not for you, the investor or the owner. They have the whip hand. There's all sorts of things in those leases. Turnover's a big one. I won't say where. There's a Coles. Oh, actually, probably there's a Coles and a Woolies I'm aware of right now, and it's for sale in regional Queensland, 2 different locations. And if you go and look at the lease, you'll find that they're not making turnover. So what does that mean? Well, there's a thing called the base rent. How does the base rent get adjusted year after year? It doesn't. So stop right there. So supposing you're buying a shopping centre with a net income of 1.5 million, of which 1 million is coming in from, say, Mr. Coles, and it's fixed because it hasn't made turnover. 1 million is your rent on and on and on. And in a situation with higher inflation, you are on the long, slow glide to the sea, like a plane without its engines, with declining real net income. So that's my problem with Coles and Woolies leases. And even though you've got, say, $500,000 coming in from your specialities, that ain't going to prop it up. So you don't want to be in that situation. So my sort of advice on those ones is I'd avoid them. Rental levels. Ensure your rents are middle of the market on the low side. Isn't that right, Mark? Apropos our conversation today. So the reason I say this is, again, for the third time I allude to this problematic situation we've got in Gladstone, where when we bought it, the rents were on the high side. But we thought, 10-year lease, ASX-listed tenant, parental company guarantee, the company's been going for 100 years. They're a huge organisation. Don't worry about the rent being high, even though Gladstone's not doing very well economically at the moment. But when they go bust and all the fundamentals you go back to all the fundamentals, if the rent that you bought it at is higher than what the market's offering, your property is worth that much down there. So I can't stress it enough. You really need to always make sure when you buy something that the rents are appropriate, and you need to seek advice from experts like valuers on that. Final point I've got in this thing is about if you're borrowing, keep the level of debt down. Might sound obvious. These days we borrow at no more than 50% loan valuation ratio. Once upon a time we were doing 60, even 65 on a couple of occasions. We'd never do that now. It's okay when interest rates are lower, but when you have a situation where everything's under pressure, valuations are being squeezed, that's when you get a call from the bank saying, well, you're going to have to reduce your level of debt. And the ultimate thing is, of course, the bank can, force the sale of the property. So you don't want to be the standout. It always reminds me of the old joke about the 2 campers in the American Rockies, and they're sitting there around the campfire, and the bear comes out of the forest and starts to run at them, and the first guy starts to put on his sort of Nikes and lace them up and get ready to run. The second guy goes, "You're crazy, man. He can outrun us. He will get you." And the first guy says, "It doesn't matter, mate. I've just got to outrun you." So you don't want to be the standout high LVR bank customer. You don't want to be in that category, because they do sort of set up various categories. You don't want to be that person. Anyway, I know there's a lot of very capable business people, and you all understand that. So have I got another slide? Sorry, yep. So how can you participate? So probably a little bit of an ad. You can directly own. I've sort of covered that. You can participate by real estate investment trusts, and there's sort of Goodman or Dexus or APN, and their offerings are out there. It tends to be the case that you've got the pro of multiple assets in the one trust. The con is that you don't know exactly what's happening, and you don't get to make the same direct decisions yourself. And And then you've got people who do what we do. There's Stronghold, there's Sentinel. These are people who we work, they're friendly competitors, and they do similar things to what we do, where they have single asset or small pooled asset trusts. You know what you're getting. And I suppose the things you should be particularly looking for there are, what are the fees and charges? What are the returns? You need to satisfy yourself in terms of liquidity. Like if you want to get out of these things, say in our trust there are mechanisms. I mentioned the unit holders agreement. You can buy and sell units. We've had people trade units. We've had death, sadly. We've had divorce, so people have had to dispose of units. But you need to ask questions of the fund manager about how you might deal with a circumstance if it came up. And also, always make sure that anybody you're investing with has an Australian Financial Services licence. I mean, that's the base level of protection that you need. So that pretty much wraps it up, ladies and gentlemen. It's been I don't think I've got another slide, have I? No, that's it. I've got some, if people did have some questions, I've got some examples as well I can talk to. But thank you so much for having me, to the directors of Gardian, and thank you for the staff as well for your support today.
Thanks very much, Campbell.